I'm going to hand over to you, Bill.
Oh, thanks, Nick. Yeah, Nick, you mentioned that I was at the Reserve Bank. That was a long, long time ago. And I remember at the Reserve Bank, of course, what you did was at 10 o'clock in the morning, you went down for morning tea, as one does. So I remember sitting down at the morning tea table talking to this graduate, and I was a bit more senior than that. I'd been to London School of Economics, and I thought I knew a bit. And after an hour talking to this graduate, I realised I'm not going to last in this joint. I don't even know as much as a graduate knows. So about 6 months later, I left. But I was really unlucky because the graduate that I was talking to was a guy called Glenn Stevens, who turned out to be the governor about 30 years' time. So it was a bad sample that I picked. Now, just let me give you a bit of an overview about what's happening, because it's a pretty extraordinary time at the moment. So central banks around the world are very, very worried about this explosion in inflation. And the reason why they're worried is that the last time that we had this was in the 70s and the 80s. 70s was basically a lost decade for the world. The share markets went nowhere, unemployment was high, business conditions were weak. And the reason was because we got a high level of inflation, we couldn't get rid of it. So no one wants to go down in history as being the central bankers that lost control of inflation the way the Federal Reserve and then Australia did back in the 70s and the 80s. And that's why you had the Chairman Powell speak so aggressively about inflation. I'll do whatever is necessary, etc., trying to encourage people to realise that they're not going to let inflation get out of control in the way it did in the 70s and 80s. So the Federal Reserve will raise rates by another 75 basis points next week, another 75 after that. They'll get rates up from pretty much zero in March to over 4% by the end of the year, which is a very, very rapid increase. But it's all or nothing because they do not want to allow inflation to get out of control. Australia has a similar problem. They've been going a little bit slower than the US. They've already at 2.35, having started at 0.1 in May, and they're going to go a fair bit further as well. I think they'll go at least another 1%, if not more. This is really, really rapid stuff that we haven't seen before. So in the 70s, what happened was that you got the inflation from the oil shock, similar story this time. But then the economy started to slow down, and so they slashed interest rates, and that's what led to the need to push them up to 20%, which is what Paul Volcker did in the early 80s. So that's what they're trying to avoid, and they'll do what's necessary to achieve that. So what is happening with inflation? Well, I see it in 3 stages. So the first stage was the one that Nick was talking about, which is when we had the COVID shock. So on the supply side, factories closed, shipping ran into all sorts of trouble. The cost of a container went up by a factor of 5. But at exactly the same time, the demand for goods was boosted because people were locked at home, handed money by the government, couldn't spend it on services, but could buy stuff online. So you had this massive lift in demand and these massive restrictions on supply. So that led to an extraordinary lift in goods prices. The supply chains were starting to ease by the end of 2020, 2021. Used car prices, which were the biggest driver of inflation in the US because they couldn't get computer chips for new cars, so everyone wanted to buy a used car. They were starting to fall. The shock was starting to subside. But then, of course, along came the war. So you had a whole new range of inflation shocks. So the oil price doubled. When the troops gathered on the border, the oil price was $60 a barrel. And the smarties realised that something pretty bad was going to happen here. And of course, it got up to 120. And you had respectable forecasters like JP Morgan, Goldman Sachs talking about $200 a barrel. But supply demand locked in. US consumers in particular stopped doing their summer driving, and the petrol price has fallen for 90 days in a row in the US, and it's now down to around $90 a barrel, having got to around 120. So that particular shock looks like it's easing. The wheat price doubled, and now it's come all the way back to where it was before the war. Base metal prices, nickel, copper, etc., took off because Russia and the Ukraine were producers of base metal. But China then slowed down dramatically with all the COVID shocks. So the demand for base metals has come off. So that second stage of inflation also looks to be relatively under control. Now, the supply shocks are still there, and zero COVID in China is where we're seeing the major new dimension of supply shocks. But it's not distributed all around China, and we think that by next year they'll have a different approach to this zero COVID policy. But certainly there's some elements of the supply shocks, but the big commodity shocks are coming back. So where's the problem? Inflation's over. And the answer is it's not over, because the third stage is now roaring away. And the third stage comes from businesses realising that the inflation psychology in the economy has changed, that people are now accepting of higher prices. So businesses who are under enormous margin pressure are finding that they can get away with increasing prices. Even Coles and Woolworths are allowing companies to raise their prices. So if you have that situation where businesses feel they can raise their prices, they'll be prepared to pay away on the wages. Unions are realising that already. But then even you may even go a bit further, and they'll go, well, okay, I've restored my margin. I'm a profit maximiser. I'll keep going. So it gets into the system, and that's where we are at the moment. So the main source of the inflation going forward in the US is all about wages now. So all the inflation we're seeing now that we saw last week that blew the markets up, it was coming from wages, coming from services, coming from rents, not at all coming from goods, petrol, etc. So that it's flipped over into this other area, and that's the one that's hard to stop. In fact, the only way you can stop that one is for businesses to realise that they can't keep raising their prices because demand is not there anymore. And that's where central banks come in. So they have to try and flatten the economy so that you can try and stop the inflation in its tracks. Because if you don't flatten the economy, then the inflation will build upon itself, feed itself into wages, and you've got the inflation problem you had in the 70s. So that's the way they're seeing it. So from my perspective, they'll slow growth next year here down to about 1%. So this year it's going to be 3.5%. The year before it was 3.5%. Next year I think it'll be very weak indeed. Household spending this year will grow by 6%. Next year it'll grow by 1.25%. That's how the model should work. But unfortunately, there's a number of complications this time around because of COVID. So what's the first complication? No workers, because of the closed borders. So normally when you're going through this sort of a interest rate increasing cycle, the labour market is starting to weaken pretty quickly. Whereas this time, of course, it's not. So why do we have this shortage of workers? Well, before COVID, we used to bring in net 250,000 people a year. Now, they weren't all workers. You had younger people, you had older people through family reunion, but a fair proportion of them added to the workforce. In the last in the two COVID years, we've lost 70,000 each year. So if you think about it, you should have had another 500,000, 250 a year, and you've actually lost 140. So you're short about 640,000 people and about 450 to 500,000 workers. So little wonder when you look at job vacancies now, normally you've got 3 unemployed for 1 job vacancy. Now you've got 0.8 unemployed for 1 job vacancy because of this huge shortage. So what do you do about that? Well, the government's forecasting that next year they'll get net immigration back to 180,000. So still not even as much as we had before COVID. So it's going to be a long road back. But even if you get back to the pre-COVID numbers, the 250, you're still left with the 500 that you're still short. And that is the problem. So what they've got to try and do is find a way to get more out of the people who are here already. So we talked about the Job Summit. So one of the things they've done there is that they've allowed pensioners to earn another $4,000 before they lose their pension. It's a nonsense. It's an insult. What they should be saying to them is, okay, you fill out your tax form like anyone else. Part of your income is your pension, and everything else you earn, you put on your tax and you pay tax like others. But that's too simple for the government. So we're in a situation now whereby the proportion of older people that work in Australia is the lowest in the developed world for those reasons. So that's one way of filling the gap, get our older people to work a bit more cleverly. The social security system makes it for many people, they can't work because they lose their social security, so they're out of the workforce. Childcare is the one thing that they are going to do much better at. That's the one thing that will come out of the budget will be the introduction of better childcare. So there's a lot that needs to be done to address this labour shortage problem. And the real worry is that if this labour shortage problem means that the economy doesn't slow down the way I'm expecting, then all they'll do is keep raising rates, both here and in the US, and they'll go too far. And that's the real worry. So let's hope that we get away with a slowdown, and you're going to have a slowdown, but not one that turns into a rampant recession, because central banks totally lose control and keep pushing interest rates up. Because at the moment we don't really know. You know, we've had, what is it now? 25 in May, 50 in June, 50 in July, 50 in August, 50 in September. So we've had 225 rate hikes. The banks have only passed on 75. The rest of it is still to come. Now they've decided they're going to pass it on, but their administrative systems means that a lot. So we don't really know exactly how people are going to react, and that's why at the moment business confidence is pretty good. Businesses are looking at what's happening and going, well, where's the problem? How people are still spending because they haven't really started to run into some of the problems that are going to come with the higher rates. And the second thing that we've inherited from COVID that is totally different to any other cycle we've been into before is that when these people were locked up for all this period and handed the money, a lot of them didn't spend it, they kept it. So they've now got about 250 billion extra in savings on their balance sheet. So when they do raise rates, some people will go, so what? Let's keep going. And so that also suggests that I believe you'll start to see a big slowdown in the December quarter that'll feed into the following year. But it's possible that you won't see that slowdown, but then rates will go up by more. So I think what they'll do is that they'll slow it down in October. The Reserve Bank Governor was grilled by Parliament today, and he said, well, yeah, you know, after you get to a certain level, you should start to slow it down a bit. So I think it'll go in 25s from here on in, but I think you're going to get a lot of 25s. I would expect at least 4 25s until we start to see the peak. And that'll be a peak of 335, and the US we think is going to 420. So the risk is that we can't get away with a 335 when the US is at 420. So the potential there is that things could go even further. So the main lesson is that you're going to see a slowdown in the economy, either with the current interest rate settings or they'll need to go even further. So is that good news, Nick?
Well, the bad news is you answered every question I'd written down in one go. So you've made my role as interviewer irrelevant. It's a very good wrap up. I do have a few questions for you. In all seriousness, point 3 that Bill made, just to make this as interactive as possible. Point 3 was business sentiment. Right, you've raised your prices because of inflation. You're all business owners. Put your hand up if you have raised your prices because of inflation as a business owner. Okay, and to prove Bill's point, put your hand up if you intend to reduce your pricing when inflation comes off. There you go, Bill. That's a lesson in economics for you, from me to you.
I think the point is, Nick, if most of the price increases that you've done so far have just been to protect your margins. You know, you've had this massive explosion in costs, labour costs, material costs, etc. But if the economy has changed, that people are quite accepting of price increases, are you going to continue to raise your prices once you've restored your margins? And the answer is you're profit maximisers, and if you can get away with it, you will. And that's what the central bank has to try and deal with. It has to make you realise that demand isn't there anymore, so you can't keep raising your prices, and then you can't give away these wage increases. Sorry, I can't keep doing it. And then if the economy slows down, the demand for labour will slow down, so labour won't be in the strong position it's in today. Because the other dimension of what we're dealing with is what came out of that summit in terms of pattern bargaining. So there were two big deals that were done with regard to the labour market at the summit. The first one was enterprise bargaining, which is when the employer deals with the workers and they base their wage on productivity, on profitability, and the employer has a fair bit of scope to deal with that. And then they have to get it registered by the commission. The thing that used to complicate that was that Julia Gillard put in a clause that said any enterprise bargaining agreement that you have, no worker or no theoretical worker can be worse off. And so it made it so complicated that 10 years ago there were 7,500 agreements registered. This year it's 3,000. So that particular model has ground to a halt, and they've agreed that they will take out that clause. So it's going to mean enterprise bargaining will be better. But the trade-off is what we call industry-wide bargaining. So what is actually being ticked off now in Canberra, without people knowing, is that you'll get to a point where it'll start with the care industries. So I don't know whether any of you are in aged care, childcare, medical care. So what will happen there is that everyone in aged care will negotiate through the union for the same wage increase, regardless of where they work and who they work for. And it'll be the same in childcare. So what that means is that the unions get control over that whole industry across the country. You get a lot more members, sign up a lot more. They'll be up from the 15% that they've come down through from the 70s, from the 60, 65% when Bob Hawke was around. But it'll mean you have this precedent of industry-wide wage agreements. Now, at the moment, an industry-wide strike is illegal. They're going to get rid of that. And you can make a case that for aged care and childcare, those industries have done pretty poorly in terms of their pay. And one of the reasons is that the award is pretty complicated, and they're small and they're not very good at negotiating. So you can make a case that maybe the unions can play a role there, but once they get their foot in the door, they'll try and expand it to other industries where that's not the case. And construction, of course, is the one that stands out. You start getting one union controlling all of construction sites around the country. So that is the big negative, the big risk around that job summit that really hasn't got a lot of attention, but believe me, in the background, it's getting ready to be part of the law. So watch out if you get caught up in that sort of a new arrangement. Be very careful.
Bill, do you mind if we quickly touch on, I'll speak for myself personally, a lot of the people in the room won't know this. In 2 weeks, I'm relocating from Melbourne to Brisbane. So I'm one of those people that are chasing the sunshine, cheaper property prices, and the question is on property prices, by the way, because they don't seem cheaper up there. Can we talk about property price outlook now, moving forward, and what your thoughts are, particularly around the resi property market, but there are a lot of commercial property owners in the room as well.
All right, so we've had a forecast for a fair while now that said that peak to trough resi will fall 16%, Sydney and Melbourne more like 18%, Brisbane a bit less. Brisbane has held up a lot better than the others, but I expect that Brisbane will be become relatively a lot more expensive because it's not going to fall as much as the others. So some of the calculations we've made, Nick, is that within 2 years, Melbourne will be more affordable than Brisbane. Now, that's a big call, but Brisbane's closing the gap pretty quickly. So residential property is going to be the first real casualty of this rise in interest rates. So when interest rates go up, how do they affect the economy? Well, if you're a mortgage borrower, pretty clear, they'll affect the economy because you're going to be paying more on your mortgage. If you're a tenant, you're going to pay more because the tenant is a borrower and they have to pass that on to you. And in places like Brisbane and Adelaide, vacancy rates are less than 1%. So the landlord is in the driving seat. And of course the other third, so a third have a mortgage, a third are tenants, and a third are owners. So the other third get hit by the wealth effect. So everybody gets affected when interest rates go up and confidence goes down, of course. And of course, on the other hand, you should be making money on your bank deposit. But the banks are very quick to raise rates on their mortgages, very slow to raise their mortgage rates. So I had a rather large deposit there for a while that got used for something else. I remember when I had it, I said to my private banker, rates have gone up. What did my deposit rate go up by? He said, your deposit, nothing, mate. Sorry.
And Bill works for the bank, so.
Yeah. So Nick, I think the main way that rising interest rates affect house prices is that banks will lend less money when rates go up because they say, well, you can't service as big a loan because the servicing costs go up. And a sort of a guideline is that if rates go up by 3%, you'll be lent 30% less. So what that means is that with rates going up by 3% in this cycle, my forecast is 3.5 really, so it's a bit more than that. That means that any new borrower goes to the bank and, hang on, we'll lend you 30% less, but that house prices, well, you can't pay that. So that'll bring down the house prices as less money is made available. But you're not going to have what we had in other, and that's why this is a complicated cycle because of the after effects of COVID. You're not going to have the normal cycle where people get thrown out of their houses because they lose their jobs and they can't service their loan. They're not going to lose their jobs in this cycle. The labour market will remain relatively tight, not as tight as it is at the moment, but it's not like 1990 when the unemployment rate went to 11%, or 1981 where it went to 11% and house prices fell, mainly because people were thrown out on the street. That won't happen this time, but it will happen via not being able to borrow as much. And it'll happen via the confidence effects. They'll be the two major factors that'll bring prices down. If you're able to borrow 70% less than you were at the peak, then that's going to affect how much you can sell your house for, how much people are prepared to bid. And that'll be the big dynamic this time around.
Thanks, Bill. I have one more question, then we're going to open up to the crowd for a couple. Say crowd like we're at a music festival, the group. ATO behaviour for SMEs in particular. So during COVID, the ATO were, I'm not going to say asleep, but they were very accommodating to SMEs and businesses around tax accumulation and bills and so on. is the new government coming to collect? How do you think the government behaviour is going to be in the near to short term?
With regard to small business?
Small to medium.
Yeah, they're not there. You're not their constituency, are you? I'm sorry, but you're not. So yeah, I think things will get tougher. The big tax debate is around which does affect you, is around the stage 3 tax cuts. So the previous government introduced 3 stages of tax cuts. Stage 1, which was targeted towards low income people. Stage 2, medium income people, and stage 3, higher income people. Now, stage 3 means that anyone between 45,000 and 200,000 only pays 30%. And at the moment, anyone between 45 and 120 pays 35, and between 120 and 180 pays 37. I think no, it's 90. 35 to 90 and 90 to. So that's a huge reduction. But the new government is saying this is helping higher income people. It is true that about 70% of the benefits go to so-called higher income people, but they pay 68% of the tax anyway. So they're just getting back their share of the benefits, whereas the first 2 stages went unanimously to lower income earners. The other thing is that the government's saying, 200,000, that's too high for the tax threshold. It hasn't gone up since 2008. And if you indexed it, it should be 250,000 now. So our tax system for individuals is incredibly unfair. And this was going to be the most important tax reform we've had since the GST. And I'm also hearing that that's going to be shelved, which would be a great shame. So that is going to be the big change. In terms of tax cuts for small business, we had that one some time ago. There's got to be no tax cuts for business in this environment. It'll be claw money back from higher income people by not going ahead with the stage 3. And that's about all I think they'll do on tax. It'll be all about spending and handouts and that sort of thing.
Okay, so
Nick, just let me... I wrote a piece I put a piece out this morning. Just wanted to give you a feel for the big picture. So what I think will happen is that next year they will get on top of inflation. So this year, in terms of markets, in terms of equity markets in particular, in terms of currencies, there's huge uncertainty. How far will these central banks have to go to get on top of inflation? And when's inflation actually going to start coming down? So this year is a very bad time for equity markets, for a currency like the Aussie dollar, because they're the sort of, if you like, the risk-on way that people go. Next year, if I'm right, and they do get control of inflation, okay, they flatten the economies to do it, but they get control of the inflation, and we've seen the peak in the central bank rates. Even though growth will be very weak, markets will want to take on risk because the uncertainties will have been taken out of the equation. So next year, I think, will be quite a good year for equities and a good year for the Aussie dollar. And then 2024, when they flatten the economies, that's when they'll start to cut rates. But the equity market and the bond market and that, they'll be anticipating that through 2023. So actually, you might say, 2023 is going to be a bad year. It's going to be a bad year for business and growth, but it'll be, I think, quite a good year for risk assets.
It's good insight. Do you think the property market's going to continue to come off until 2024?
Yeah,
based on that?
think, well, the big question mark on residential will be when the Reserve Bank makes it clear that they're on hold, they've gone far enough, will that immediately click the residential market back, or will they wait a little while? I think they'll probably wait, but I would think that all the pain will be out of the way by the middle of next year, but it will be quite extreme pain. And then markets will stabilise, and then when they start to see the likelihood of rate cuts, that's when people will be wanting to get ahead of the game. On commercial property, the only thing I know for sure is that industrial commercial property cannot sustain itself below the risk-free bond rate, which is where they are at the moment. You know, the risk-free bond rate in Australia is about 3.7, and I'm seeing industrial deals going through at 3.25. That's not sustainable. Reminds me of the GFC. Before the GFC, retail and office yields fell below the bond rate, and everyone said, this is great, isn't it? And then the GFC hit, and things changed pretty quickly. So I think industrial is the one that, to me, looks the most vulnerable. I don't understand CBD. You know, people try and tell me that the occupancy rate's going up, but I know in the Westpac building, takes 6,500 people. On Mondays and Fridays, you've got about 800 there. I know that because the coffee shop guy counts them, you know. he finds out from and in the middle of the week it's about 1,800, and it hasn't changed for some time. So I don't see, if I own a business in the CBD, unless it's Vue de Monde, which is just a product amongst alone, but I think that we're just going to have to get used to a different world that's will mean, I believe, that at some point the boom in CBD construction will have to come to an end, because you're not going to need all that property. There'll be a point when the Fed is finished, inflation's coming down, they'll look at the US economy and go, gee, that's got problems. Then you'll start to see a weakening in the US dollar, but not beforehand. While the uncertainty is here, the US dollar is king. So I would certainly believe that between now and the end of the year, it'll remain in the sixes. But I've got 75 by the end of next year, but it's next year. So I'd be careful between now and when the whistle gets blown that says that the Fed's on hold, they've done enough, then you'll see a huge turnaround in currencies, but not until then.
Thanks, Bill. Joe?
But if you look at the Aussie dollar against the other currencies, so they have what they call a trade weighted index, which is weighted by the share of trade. So Chinese renminbi gets a weight in it, the euro gets a weight in it, etc. Over the last year, that has lifted by 2%. Against the US dollar, they're down 10%. It is a US dollar story rather than a bad story for us, because we have never had a better trading position than we've got at the moment. Never, ever.
But we've seen a drop in the euro from 69 to 66 over the last couple of weeks.
I think that's because the Europeans have come out and raised rates by 75 basis points. You know, they've got huge problems there. But certainly, if you look longer term, we've done pretty well against the euro and against the yen. But against the US dollar, it's been a basket case. Everyone has. So what that means is that with a really strong US dollar, you've got to look at some of these emerging markets, you know, these smaller countries that have got a lot of debt in US dollars, and that's going to be really start to inflict pain. And there's countries in Asia that are in that situation. So you'd be very careful to look at those, because that was effectively what generated the Asian financial crisis back in the 90s. So be very, very careful about Oh yeah, if you want to talk about someone in trouble, then Turkey's always top of the list.
Okay. Turkey, I think now is the correct term. They've changed their name. We've got time for one more question, guys. Put your hand up. I think that answered Joe's question, the last one. Anybody got any more questions for Bill?
Yeah. Tom.
That's a spicy question.
No, look. I never invest in anything I don't completely understand, and I really don't understand those cryptos. I think if you look at the incentive for people that invest in them, it might be 10% that invest in it for structural reasons. It's a new way of trading, of settling transactions. And most of them are there for gambling reasons, and that's very dangerous. So you just don't know enough about it. I'd be very, very careful about that. It had a bad run. They've had a bad run, haven't they?
That includes me personally as well. Okay, we're going to wrap up, guys. We're going to have lunch. We're going to have that tequila at the bar. Bill is going to shout everybody the next round of drinks. I'm just joking. Can we give Bill a round of applause, please? Thank you for joining us today.
Hey, Nick, a question for you. If you're going to Brisbane, then presumably you're going to be backing the loser tonight.
Always backing losers with crypto and everything. I just can't win, unfortunately. So
you're not a
No.
Cats. You're a
actually,
Brisbane supporter.
I'm a Swans fan. So
Swans.
Swans.
Well, I did a dinner last night, and we had 15 pretty sensible people around the table. I said, well, who's going to win the flag? And we had 9 for Geelong and 6 for Collingwood, and not one vote for Sydney. Maybe it's because I'm in Melbourne. I
think so. No, you've done great. Thank you for your help. You're very respected in the industry. We appreciate Westpac's support. We appreciate you coming today.